Well, good Sunday evening and good morning, wherever you are. Thank you for joining tonight's program. And that's right, there is not a spelling error in the title. That's right, we have Peter Schiff with us this evening. And as well, Cyrus Jansen is joining the panel. As you know, in the last week here, in the last couple of weeks, we have seen a collapse in the SVB Bank in the United States. Credit Suisse went to the wall, who apparently was within 24 hours of running out of money. One by one, they fall. Let's bring on the panel. Mr. Schiff, welcome to the program. What a pleasure and what an honor it is to share screens with you, Peter. Peter, the latest news I had was Deutsche Bank. Who or what is next, Peter?
Well, a lot of banks are in trouble thanks to the reckless monetary policies of central banks around the world, particularly the Federal Reserve, the bank, the European Central Bank, the Bank of England, the Bank of Japan. They've kept interest rates at zero or in some cases negative for a decade or so, maybe and more in some cases. They've also greatly expanded their balance sheets through quantitative easing programs where central banks have been artificially manipulating the price of government debt and basically by extension, all debt. And so as a result, a lot of these banks are now the owners of, longer term government obligations and other obligations like mortgage-backed securities that now in an environment where the Fed has finally decided to allow rates to rise to fight off the inflation that it created. Remember, the inflation that we're experiencing is a direct consequences of the mistakes that these central banks made. So the same mistakes that are responsible for unleashing the inflation are the ones that are responsible for the banks now being insolvent. And so as the central banks are, raising rates to fight inflation, they are exposing these insolvencies because now the value of the bonds that the banks own is dropping. And so when depositors want their money back, it's not there because it's been lost because the market value of these bonds isn't equal to the deposits. Now, if the depositors are willing to wait 10, 20, 30 years to get their money, maybe they can have it. But they don't want to wait that long. They need their money now, especially since costs are going up. They need more money to pay higher prices. And because there's a way to get yield now, because all these banks, because they've already committed their deposits to these long-term obligations, they're collecting very low interest rates, maybe 1%, 2%. But depositors can take the money and put it in a money market, loaning it to governments, and get in the U.S., they can get 4 or 5%. So, it's easy math to do. The banks can't raise rates because they've already committed the money to lower yielding assets. So depositors want their money so they can put it someplace else to get a higher yield, but the banks don't have it. Right? So this is a problem. I was warning about this specific problem as well as many others over a decade ago. I knew what the end game was going to be. I didn't know how long the game was going to be played. I just knew how it was going to end.
Yeah, those are some great insights, Peter. And thank you for joining the show. It does seem, one of the interesting things that we do here on the show is we talk a lot about geopolitics around the world. And we do see an interesting movement right now across the world of de-dollarization. A lot of countries moving away. For example, there's a lot of moves between Saudi Arabia and China, certainly linking closer together. The potential for the birth of the petro-yuan, where they're not going to be always selling their oil, in United States dollars. What is your feeling on that? Do you think, obviously, once Richard Nixon took the U.S. dollar off the gold standard in 1971, we had to do something, right? We had to shift, and that certainly went to oil. We obviously pegged the oil, then Saudi Arabia to the United States dollar. I think many Americans, we feel that that's kind of our monopoly that's going to just run the tables forever. That's going to be our superpower. But do you forecast that changing anytime soon?
Well, the soon part, that's hard to say. And how do you define soon? Next week, next year? Hard to say.
Right.
But I do believe that it's going to change. Yeah. The only question is when. This is a privilege that the United States has enjoyed going all the way back to the 70s. It was something that I think the Nixon administration got the Saudis to agree to. in exchange really for our defense of their regime. And that was done following the decision by Nixon to suspend redemption of U.S. currency in gold. And since the U.S. dollar was no longer backed by gold, Nixon decided, well, we need to back it by something. And he was able to back it by oil in Saudi Arabia and the rest of OPEC, because now you needed dollars to buy oil. So it created a use for those dollars. And so it allowed America to run trade deficits because people needed dollars to buy oil. If they didn't need them to buy American products and they couldn't use them to get gold, they could use them to acquire oil. But I think that the world, for many different reasons, wants to move away from providing the United States with this privilege, because it doesn't come, for free. There is a huge cost that the world bears in terms of a lower living standard and lower consumption, because it helps, support American profligacy. Americans get to live beyond their means. And to make that possible, the rest of the world collectively lives beneath its means. And so there is a economic cost to having the dollar as a reserve currency. But now there's another cost, a political cost, because the United States has weaponized the U.S. dollar. And we are using our dollar status to punish countries that don't do what we want them to do. Like, look what's happening with Russia. So that's sending a very powerful message to the Saudis and everybody else to de-dollarize because they are vulnerable. It's like putting your neck in a noose and then throwing the end of the rope to your adversary and hoping they don't pull it. So I just don't think that they want to do that. And so I think there are a lot of reasons now to de-dollarize. And I think that's already in the process. And so it's just a question of time. And again, I don't know how many more days, but the dollar's days are numbered as the reserve currency, as are its days as the unit of account for oil in the OPEC nations.
So let me jump in for a moment. And Peter, if we can, just pull your microphone maybe just up a little bit up of your collar. That would be helpful. Everybody is really tuned in to really wanting to hear what you got to say. No problem. So, Peter, I've been watching you since 2006, 7, and 8. And wow, did you nail it on that one there. My concern is, coming out of this pandemic that we've seen over the last couple of years, I'm still baffled as a market player on why the markets reached their all-time highs in, 2021, 2022. Why are they even there? And is it true, maybe I can get your opinion on this, that majority of the S&P 500 companies, there's actually really not much in them? Maybe you could help me out with understanding this a little better.
Well, first of all, when you look at the S&P making new highs, it was a handful of stocks that are responsible for the new highs. So most stocks did not make new highs in 2021. But the reason you had certain stocks make new highs, and those stocks were disproportionately weighted in the S&P, that was, the monetary and other policies during COVID. Because what happened in COVID is the central banks flooded the economy with new money. And a lot of that new money went to buy stocks. A lot of people were sitting at home with nothing to do, and all of a sudden they had a lot of money and they had nothing to spend it on. So they decided to buy stocks, right? You have a lot of Americans, with brokerage accounts that are on their cell phones. And they were buying stocks. And of course, the stocks they bought were the FANG stocks, these stocks that did make new highs. They got sucked into those, as well as some other meme stocks. They also bought some cryptocurrencies and NFTs and crap like that. But also, perversely, the FANG type stocks were the ones that specifically benefited from the COVID lockdowns, because their ability to make money wasn't impaired. In fact, it was enhanced, because a lot of people were stuck at home and they couldn't spend their money, in the normal way that they would on other services or at other brick and mortar stores. All that extra cash, to the extent that consumers spent it, went into these few highly speculative names that are heavily weighted in the S&P. And so that helped, get the speculation really going in these stocks. I mean, people just saw the momentum and everybody wanted these shutdown, lockdown plays. And so all the money was just going to these stocks. And since they were going up, the momentum attracted even more money, which kept the momentum going. And so everything kind of hit new highs in that mania. And at the time, I looked at what was going on and I said, this has got to be the end of it. This has got to be the blow off top, not only for the bull market, but for the bubble. Because normally when you have a long bull market like the one we had, which becomes a bubble, it ends in some spectacular melt up, right? A blowout. And that's really what we had in 2021 with the new highs in these FANG stocks, as well as the interest in meme stocks and NFTs and cryptocurrencies. I think all that hit ahead in 2021, and now the air is coming out of these bubbles.
Before Cyrus carries on there, I just want to add to that. My understanding is, the downtown core in some of the U.S. biggest cities, New York, Chicago, I mean, they are absolutely obliterated. These small businesses, these shops, these bars, these restaurants, the downtown core, the work from home now. This has really, really killed, a lot of the, center cities, we'll call it central business districts business. On top of that, one other question, and I'm firing them away at you because pleasure to have you on the screen with me here, is that I'm hearing a lot of people's mortgages are going to be about to reset. And I'm hearing from my friends in Canada, especially, that borrowed money at quite a low rate are now fearing walking in to, extend their mortgage now. Everyone was playing the 5-year rate and, time is ticking on that. I mean, are we going to see another housing crisis crash here?
Well, it's not just housing. It's anything that was related to borrowed money. This is the other side of the coin. When rates were low, there was a temporary benefit associated with that. Everybody who was a debtor got a good deal. They were able to save money on their debt. Now is the flip side. Now that rates are having to adjust back up, now all the debt that was accumulated when rates were low has to be serviced and repaid when rates are higher and headed a lot higher. In theory, if the central banks are really determined to reduce inflation, then interest rates have just started to go up. They have a long way to rise. And this is going to be a problem for everybody who has borrowed money. Now, certainly in the housing market, probably the majority of people who buy homes can't afford to pay cash. They take on some type of mortgage. And some people in America took on a 30-year fixed rate mortgage and they refinanced it multiple times, and now they've got a really low rate. I mean, I did that myself with a house I had in Connecticut, and I had my final rate was 3 3/8 on a 30-year fix. Now I have maybe about 26 years left on it. Not really sure how many, but I'm very reluctant to sell that house because I don't want to repay that mortgage. It's very cheap money, and so a lot of Americans are in that situation. But there are millions of Americans who do not have a 30-year fixed rate mortgage, who opted to save even more money by taking a 5-year ARM, for example, where you had an even lower rate for those 5 years than what was available on a 30-year fixed. But now they're going to have to pay the price for that because let's say their 5-year time period is up this year or next year, and now the rate resets to what the current market rate is. There may be some limits to how high it can go or how rapidly, but this is going to be a big shock to a lot of people who are not going to be able to afford the higher mortgage, especially since the cost of everything else has gone up. So they're paying more for food, they're paying more for electricity, for insurance, for maintenance, for taxes. Everything has gone up, and now their mortgage is really going up. So that's a big problem. Plus, there are a lot of people, even though they may have had a 30-year fixed rate mortgage, they took on a second, like a home equity line of credit or some type of additional debt that doesn't have a long maturity, that resets. And so Americans are going to be in trouble for that reason. And I know up in Canada, you don't have those 30-year mortgages. I think you have a much higher percentage of people who have shorter-term mortgages. And that's going to be true all over the world. I mean, I remember I was over in Europe, when I was there on vacation, looking at property, and in some countries, they were actually paying you to borrow money and buy a house. You had a negative mortgage. Right?
Wow.
You actually were paid to take on the debt. Well, but it was short term. It wasn't fixed forever.
Right.
And so people may have taken advantage of that, and for the last couple of years, they have had, effectively no payment on the debt. Now, all of a sudden, they have to start paying. And of course, that's a big problem. But it's, corporate America indulged on all this cheap money. Where do you think all the money came from to do all these buybacks, these record share buybacks? It wasn't earnings that was driving it. It was debt. Companies were told, hey, look how cheap you can borrow money. So you might as well borrow money while it's cheap and then buy back your stocks and push up the share price. And that's what they did. But these loans are coming due. Where are the companies going to get the money to repay the debt? I mean, are they going to sell stock? And at what price are they going to get? You saw what happened when Silicon Valley Bank tried to issue stock to cover its losses. Nobody wanted to buy it.
Yeah.
And the stock went to zero. So that's going to happen. And, commercial real estate is a different story than residential. There are no 30-year fixed rate mortgages in commercial. Almost all those loans are 3-5 year, time periods. And then the borrower has to roll over the debt. I mean, they don't have the money to repay it in most cases. So they're going to have to go and reborrow the money, and the rates are going to be much higher. So this has always been a ticking time bomb. And I've been warning about it since the Fed lit the fuse in 2009.
Yeah.
I mean, it's really lit now. And what bothers me about it is, I mean, how do we prepare for it? I mean, I'm here in China right now. I haven't heard a Chinese bank go under. I've heard American banks go under. I mean, Deutsche Bank on Friday was hitting, a 12% down. I mean, is this just the start with the banks? I mean, I have seen absolute capital being wiped out as a shareholder. I mean, you got to be very cautious as a shareholder nowadays. If you're relying on money from the stock market, I mean, and you owned SVB Bank or even Credit Suisse as of early as Wednesday morning, you're gone. I mean, They don't talk about the equity loss here on people. And how many more of these phantom companies are out there, phantom banks? Peter, help us with this.
Well, there's a lot of them out there. I mean, that's why I've pretty much avoided the entire sector. If you look at the funds that we manage on behalf of clients or through our mutual funds, we haven't really had any financials. We've underweighted them, dramatically. There's something like 20% of the benchmark or the index, and we basically don't own them. And this is why. I mean, I've avoided them like the plague because I knew that they had this disease. Now, for a while, that worked against me because while I wasn't buying the banks and everybody else was, the prices were going up. And then in particular, people kept saying, well, when the interest rates finally go up, it's going to be good for the banks because they're going to earn more money on interest. And I kept saying, no, it's going to be a disaster for the bank because it's going to destroy the value of their assets. I talked about it specifically, why rising rates were going to be bad for the financials. And since I always knew rates would eventually rise, I didn't buy them. And so for years, my funds were underperforming. And as a result of last year, they're now at the top. They're number one. I mean, I've been getting awards from Lipper gave me an award for the best fund of 2023. I got number one from Morningstar, from U.S. News and World Report came out with a special piece. They ranked the top 60 international funds out of like 350. And I had number one and number three. And I only had two funds in the category, and I got 1 and 3. Goldman Sachs somehow shoehorned in between me. One of their funds made it to number 2. But I think I'm going to beat that fund with both my funds this year. That's my opinion, as my forecasts continue to prove correct. I mean, they were early, and because they were so early, a lot of people dismissed them as being wrong. No, they were just that prescient because I was able to tell from such an early point where this was headed, because I understand the consequences of the monetary policy mistakes that the Fed and other central banks were making, whereas most people in my industry, asset management, or even professional economists, other forecasters, they don't even understand yet that the Fed made a mistake. So if they don't know that the central banks got it wrong, then how would they know what the consequences would be? And so that's why I was able to see it so early. And the reason that so many people are still so confused by this, and so many in the financial media are acting as if this is a surprise. Like, this came out of left field and nobody could have seen it coming. It's because they still don't get it. And they said the same things in 2008 or after 2008, that nobody could have seen this coming. This was a black swan. This was, something no one could have forecast. It was a 100-year flood. And I was like, hey, wait a minute. No, I did forecast it. I did see it coming. I warned about it for years, just nobody listened. In fact, not only did people not listen, they actually laughed at what I had to say. Now people are talking about how all those problems were obvious. No, they weren't. They were obvious to me. But even when I pointed out the obvious to other people, they still didn't get it. And the same people don't get what's happening today. They keep saying this is not like 2008. In a sense, they're right, because it's much worse than 2008. But they're making the comment to dismiss this. In fact, nobody wants to call this a financial crisis, but that's exactly what it is. This is a financial crisis. A financial crisis has to do with banks. That's what happened in 2008. You had some banks failing because they owned bad debt. Well, what do you think is going on right now? And in fact, more banks are failing even quicker now than back then.
Yeah, it's quick. Seeing that. I'm going to pass this over to Cyrus now. Cyrus, you have quite a bit of stuff that you want answered from Peter. Go ahead.
Well, yeah. I think that's fantastic insights, Peter. I really appreciate it. And just to kind of give some perspective to everybody and to kind of, just to confirm what Peter's saying. It's interesting. I lived in Canada for the last 5 years, and we have some Canadians in the chat here, and it is interesting because Canada does not offer that fixed mortgage. It's impossible to get a 30-year fixed mortgage. I have a good friend of mine that bought a house, and very happy because he got he's close friends with the bank manager, so he got the best available rate. He's locked that in for 5 years, but as I think he's about 2.5 years in, and then that expires. And then it goes right to whatever that market is. So he's already anticipating. I'm going to have a good mortgage payment for the next 2 years, but the chickens are going to come home to roost in 2 years, and that rate's going to be much, much higher. So we have to anticipate that. Another interesting thing, I'm here in Las Vegas, Nevada, and in our neighborhood, we have actually seen a tremendous amount of, it's a new neighborhood, new build, and we've seen a lot of people that were buying houses last year. They didn't get their finances in order. They didn't lock down that rate, and we've seen so many houses just hit the market because they just can't afford the mortgage payments. What they started on construction last year, now it's like, okay, it's time to close. We didn't get that. We didn't lock in that 30-year fixed rate. Well, now they can't afford that mortgage, and they've had to just put the house on a fire sale. We've seen prices just crash. House one for 1.6. Okay, now it's 1.3. Wow. Yeah. We're just taking $300K right off the bat, and they're just trying to dump as fast as possible to get out of here.
That's an important point that I was making for years with respect to what would happen when rates ultimately had to normalize.
Yeah.
And you have, some people like your buddy who still has 2 or 3 years left on his, super low rate. So as long as he doesn't want to sell his house or doesn't want to, use it as collateral for some other loan, he can enjoy those low payments for another couple of years. And what he should be doing is saving money so that he has the money to make the higher payments.
Right.
But if he decides that he doesn't want to live in that house anymore, that he wants to sell it for some reason, the pool of potential buyers don't have access to that low rate. They now have to borrow money at the market rate. And so if your ability to buy is a function of the monthly payments on your mortgage, the minute the mortgage rates are high, the real estate price has to fall. It's just like a bond, right? Mortgage, real estate is almost like a bond in the sense that it moves opposite with interest rates. So bond prices went up when interest rates were low. That's why all these banks have lost so much money, because interest rates went up and the value of their bonds went down. Well, that's what's happening with real estate in a higher rate environment. If you have to pay more to borrow money to buy a house, then you have to pay less for the house. The mortgage rate helps determine the demand for housing. And
absolutely,
as the rate goes up, the demand goes down. People still want to live in a house, but they can't afford to pay as much money. So a lot of people that got these low rates, if they bought their home during the time period where those rates were low, they paid a very high price. The people who are in better shape are the people who already owned a home before the prices went way up, but had a mortgage, and then they refinanced the mortgage at the lower rates. I don't know to what degree that went on in Canada, But that went on a lot in the US. But the flip side of that is those mortgage-backed securities are out there owned by somebody. So the gain for the borrower is the loss for the lender. I talk about that a lot with my own mortgage. So if I've got this 3 3/8 mortgage, which is, up for the next 25, 26 years, Bank of America owns that mortgage. They're going to be losing money on that mortgage for 25 years. I mean, they don't want that mortgage anymore. I mean, what good is it? I'm paying them 3 3/8. They could get more than that if they just park their money with the Fed.
Right.
And if they went to sell my mortgage, maybe they'd be able to get 70 cents for it, 65 cents. I don't know. But now they can just take that crappy mortgage and hand it to the Federal Reserve and get back $1, even though it's only worth 70 cents. And that's obviously what's going to happen. And that's why the Fed's balance sheet is going to balloon and why inflation is going up, not down, because they have to print money in order to get a Bank of America out of jail. But, so all the money that all the borrowers are making is a function of what everybody else is losing. And I was pointing this out for 10 years, talking about the other side of the savings. Everybody wanted to focus on how great this was, that everybody could refinance their mortgages at these super low rates. And I kept saying, but what happens to the lenders when rates go up? This is a financial crisis in the making. And of course, now the crisis that I warned about for a decade is upon us.
Yeah. Peter, I want to, we focus a lot on U.S.-China relations, and I have an interesting take here because, a lot of times, geopolitically, I mean, obviously the big story right now is the United States and China are moving towards a conflict, and most likely the conflict is going to be involving Taiwan. And, there's a lot of talk about a military conflict and things like that, but I want to talk about a potential economic conflict. Like, what if we were in an economic Cold War between the United States and China, which is actually a very interesting scenario to think about and to discuss because, I mean, despite the tensions and the decline in the United States-China relationship, last year, I think the United States bought $547 billion worth of products from China. And we find ourselves in a very interesting catch-22. We want to decouple. Everything is decouple from China. I mean, I don't see how we can possibly do that. That's one of the messages that I consistently preach on this channel is how vital China is to the success of the American economy and just our way of life here in America. I mean, everything that we're recording with today all comes from China. I mean, we really rely heavily on China. But I mean, what about if we had an economic kind of Cold War? How do you see that positioning, between the United States and China? What are your thoughts on that?
Well, I mean, we're not in a position to fight the war. We're not even armed, so we would lose. The operative word there is bought. Right? You talk about how much we buy from China. Well, buying implies paying, right? If you bought something, then you paid for it. But we haven't really paid for anything that we get from China, right? Because how do we pay? Because the Chinese send us actual stuff, right? Real products like, some of the consumer electronics that you're using in your studio there, right? So where did they get these products? Did they just, wave a wand and they just magically appeared? No, they needed to devote actual scarce resources that could have been used for something else. They had to take land, labor, and capital and use it to produce those goods, which they then shipped over to the United States. And then, of course, they had to pay the cost of shipping them over there. And then they had to pay the cost of bringing the ships back empty, because there's nothing that we put on there. So they have to come all the way back empty so they can get loaded up again with more stuff, right? So the Chinese are expending a lot of resources, labor, capital, land, to produce these products and ship them over to the United States. And what are we shipping back to China, right? What are they getting in exchange for all that hard work and all those resources? Our paper, right? Dollars, Federal Reserve notes.
Right.
Well, where'd they came from? Well, they came out of thin air. We just conjured them into existence at the Fed, right? At the click of a button, whatever. We don't even have to use paper and ink anymore. We just create it magically, in cyberspace. And now we send that over there, right? Electronically. That's why we don't need a ship, because it's just nothing.
Right.
And so then what do the Chinese do with these dollars? Well, they lend them right back to us. They buy treasuries. They buy mortgage-backed securities. And so what did we give up? Nothing. We got all this stuff, and we didn't have to do any work. We didn't have to expend any resources to pay for it. On the other hand, the Chinese had to use up all these resources to make stuff, and they got nothing to show for it. And so this is not a symbiotic relationship. I think this is parasitic. I think the United States is gaining at the expense of the Chinese and everybody else who is participating in this game. But I think what will eventually happen when the Chinese come to their senses, and they eventually will. I mean, you can't expect them to do something this stupid indefinitely. I mean, they're not dumb. They'll figure it out if they haven't already figured it out. And they're going to want to end this parasitic relationship. And so what would happen then? Because everybody thinks, well, China would be in a lot of trouble if, they couldn't ship all their stuff to America. It's like,
Right.
no, the Chinese would all of a sudden be in a much better position because they could take those exact same goods that they're shipping to us, and the Chinese can buy them, use them themselves. Chinese workers could actually enjoy the fruits of their labor. And if they don't want the identical products that are being manufactured for us, well, they could use that capacity and that labor to do something that they do want
Right.
instead of doing something that we want, right? So they have the resources, they have the infrastructure, they have all the necessary accoutrements to wealth and to increasing their standard of living. We don't. Because in the relationship where the U.S. and China no longer trade with one another, the Chinese keep all their stuff and they get to enjoy it, and we no longer have access to that stuff. So we have a huge change. So now the Chinese get more stuff to consume, we get less. So what happens in America? Prices skyrocket. You
Absolutely.
go over to Walmart and all the shelves are empty. There's nothing there to buy.
Right.
Hey,
And we've actually seen that a little bit, right? We've already seen that a little bit, with the COVID and
Yeah,
when we see these trade issue, these supply chain issues, right? I mean, we've experienced that already. We've already had a little preview of what that would look like.
So basically, we keep all of our paper money and they keep all their stuff. And so they get lower prices and more stuff. We get much higher prices and less stuff. All we have, our inflation stays here. We can't export our inflation to China anymore. It stays in the United States, and we have to suffer the full consequences of that money printing. And of course, there's going to be a big snowball effect because we have an entire economy built around the distribution of stuff that we get for free from the Chinese and everybody else. So if Walmart no longer has anything to sell, well, Walmart can't be in business, or at least not at the scale that it is now. So it has to start cutting back. It has to start laying off workers, right? The entire service sector economy collapses if it no longer has any goods to sell, right? We're just a distribution machine for the stuff that everybody else makes. Well, if we can no longer import that stuff, then we don't need to distribute it anymore. And so the recession that would accompany, this cessation of this relationship, I mean, would be catastrophic.
Yeah, let me jump in here, Peter. I get this question a lot of times on a lot of my videos. I make a lot of videos on China, of course. And I just want to once again welcome you to my audience at Reportify Media. The question always comes around and it says, listen, Alex, China could not survive if America stops buying goods from them. That's the first one. And I need you to answer that one. And then the second one is Cyrus and I are going to pull up a couple of slides on derivatives. We need you to kind of help us out on that one. So the first question over to you is, it always comes to me, and I'm always looking at a way to defend this when they say, hey, Alex, the moment that North America stops ordering anything from you, from China or over there, the lights are going to go out for China and it's game over.
Yeah, well,
help us out.
Again, the word is buy. We're not buying. If anything, they're vendor financing. So they're loaning us money to buy their stuff, even though we can't pay back any of the money we've already borrowed to buy the stuff that we bought, yet they keep loaning us more. So the sooner they stop throwing good money after bad, the better. Because again, the factories that the Chinese have aren't going to go away. Okay? The labor, the skilled workforce, all of the supply chains, all the stuff that has been built up, all that real investment will remain in China if they stop shipping stuff to us. So doesn't that stuff have value? I mean,
Yeah.
and look, if they don't sell to us, they can sell to somebody else. It's not like Americans are unique in that we want things. The rest of the world wants stuff. So in theory, they can sell to the next highest bidder that Americans were able to outbid. But I think more likely, more of their production will be consumed domestically. And so they won't export it. And you have to remember a key economic point. Export is not an ends in and of itself. Exporting is a means to an ends. Why do countries export? To gain from comparative advantage. If you produce something very efficiently, you want to produce more than you need so that you can export it, and then you can use your earnings to import something else that maybe you aren't as efficient in producing. And as a result, you end up with more goods to consume because of exports. But if you're simply exporting for the sake of exporting, then you're wasting your resources. It doesn't make any sense. And that's what the Chinese are doing, because all they're getting in exchange for their products is our paper. And the only reason the paper doesn't crash is because they keep buying it and they keep loaning it back to us. So no, I mean, China does not need us at all. We need them. And that's what people just don't seem to get, right? Because it's not like we can produce the stuff that the Chinese are producing, because if we could, we would be doing it right now. We can't.
Yeah,
now,
that is so true.
Could we eventually do it? Yes, but it's going to take years, if not decades, of investment. And in order to do that, we have to reduce our consumption, because you can't spend and invest the same money. So it's one or the other. You either consume it or you save it and invest it. And so we haven't had to save and invest because the Chinese have been doing it for us. But now we don't have, anything to show for it. So if we want to rebuild what we lost, because at one time, all the stuff that is in your studio, all that consumer electronics, if you were able to have, do this in the 1940s, 1950s, everything would have been made here. We made all that stuff ourselves, and we exported it. Right? But we don't do that anymore because we relied on the rest of the world to do it for us. And we've used the dollar's reserve status to get away with it. But if we have to go back to a independent, self-sufficient industrial economy again, and we have to start producing stuff, that's going to take a long time. And during the interim, there's going to be a huge recession because the phony economy has to collapse. Now, the good thing is, there have been a lot of improvement since the 1940s, in technology that would make a return to industrialization easier, more efficient. I mean, even what's happening now with artificial intelligence, I mean, that has the potential to help make America more productive. Of course, the same is true for the rest of the world, but it's not going to happen overnight. And it's going to require, in order for this to happen, a big reduction in government, because government is going to have to cut spending dramatically in order to relieve the domestic economy of the burden of paying for all that government, because we can't pay for all that government and then reindustrialize our economy at the same time.
Right.
So we have to lighten the burden on the private sector because it has a Herculean task in front of it. And it's going to be impossible if it's also burdened by high taxes and high regulation. I mean, that is something that would not have a big cost to the government, but would have a huge benefit to the country, which would be repealing a lot of rules and regulation that unnecessarily inhibit our productivity. And in fact, those rules and regulations are part of the reason that we outsource everything to China in the first place.
Yeah. Well, I think one of the other things, Peter, that's amazing, I mean, being back here in the United States, just one last point, Alex, before we go to this one, is it's quite interesting is just when you look at workers. I mean, we simply we can't hire workers to work in a restaurant. I mean, so I mean, it's amazing because we sometimes get comments like, we don't need, Apple doesn't need China. Just bring back the Apple factories. We can manufacture our iPhone, here in the United States. I'm like, no, you know what? We definitely can. I mean, we certainly have the technology and the process to do that. Your iPhone's going to cost you $5,000 to $6,000. I mean, so as long as you're willing to to pay 5 times more for your iPhone, let's pony up, let's go for it. But, the problem is
nobody will. And in fact, one of the reasons people were able to buy the iPhones at all, even to pay $1,000 for an iPhone or $1,200, was because of the cheap financing.
Yeah.
right? The cell phone companies were fronting the money. Well, why were they doing that? Because money was so cheap, they were able to do it. But as interest rates rise, all these cell phone carriers can't afford to offer this kind of financing. And so that means that people that have iPhone 14s, they're not going to be lining up for iPhone 15s
Right.
because they're not going to be able to get those sweetheart financing terms.
Yeah.
So people are going to stick with their phones a lot longer. And of course, why not? I mean, there's nothing wrong. I mean, even if you're still using the iPhone 11 or whatever, 10, they still work good.
Yeah.
You know, it's not like, you know, you need to get the newest. But when the cell phone companies were just giving them to you for nothing, well, just here, just take it. You know, we'll, no interest, and we'll spread the payments out when they can't do that anymore. So yeah, these companies are in a lot of trouble. And if they had a manufacturer here, they'd be in even worse trouble. And of course, if the iPhone was manufactured here and it went up in price by 3 or 4-fold, then people wouldn't even buy iPhones. They would just buy the phones from a different manufacturer that wasn't manufacturing in the United States, because the product would be far more competitive.
They probably go to Xiaomi, one of the leading Chinese ones.
Samsung would just, would love it to see the Apple try to produce everything here.
Yeah, absolutely. We have had a lot of questions about Chinese banks. What is the status of Chinese banks? And this, Alex, go to the next slide, and you go ahead and open up this question.
And just to jump into that, there's a lot of wealth being lost in, depreciating assets, cars and stuff like that. I've seen it. I did a little calculation on how much my sister, as a school teacher, has traded in her car, I think, 5 or 6 times over the last 12 to 15 years, and how much wealth has done on that. I mean, the biggest promoters, some of these car manufacturers that promote these products, as Peter was saying, with cheap financing, we are getting promoted by Janet Yellen as we speak. So here's a couple of slides that I would like to bring up on the screen here. Peter, maybe you can help us out with this one. So this first one here is the comparison of the top 4 banks in the US to China in trillions of dollars. The one on the, I guess it would be the right-hand side, is the USA and China, and this is derivatives. Maybe you can explain this one to Peter, Cyrus.
Well, I'd like to get Peter's analysis on this, because when we look at the assets, we're looking at assets. So we're looking at that on the left. It appears that the Chinese banks, there's the top 4 banks in both the U.S. and China, so we've got a lot more assets inside these, Chinese banks. And then on the right, as the United States owns a lot more of these derivatives. This is just our general question. We've obviously seen, United States banks collapse. Deutsche Bank is really not, I'd say, next on the chopping block, but there's a lot of speculation over that. One of the things we know is there's never one cockroach, right? Once, you see one cockroach in the kitchen at night, it's never one. There's always a bit more underneath once you start looking at that. So, I think it's safe to ask, what about Chinese banks? Are they better positioned? What is your feeling on that? Are we really looking at an entire global crisis here that, Canadian banks and African and Asian and every bank is really at a risk right now? What are your thoughts, Peter?
Well, first of all, on the cockroaches, sure. Especially when they're all eating the same food. I was saying the same thing in 2007 when the subprime problems arose, and the Fed and everybody else was saying, well, it's contained to subprime, right? It's unique to these subprime markets. And my point was, no, it's not unique to subprime. Subprime is the weakest link in the chain. That was the craziest part of the mortgage market. And so it makes sense that it would buckle first. But I said, this is just the tip of an iceberg, that there are problems throughout the entire mortgage market, not just in the most extreme example. And now the same thing is happening again when you have the failure of Silicon Valley Bank, and they're like, oh, well, this is just a unique situation to Silicon Valley Bank. It's because, it has so many tech customers or crypto, and, it had such a high percentage of the deposits were uninsured. All that means is that it was the weak link in the chain, right? So the problem now is no more contained to a handful of banks than the mortgage crisis was contained to subprime. It's just the initial impetus of everybody is to dismiss it. We don't have to worry about some huge crisis. This is an isolated event. Everything is fine. And again, they're as wrong now as they were then. It was similar to the way they greeted, inflation rearing its head finally. Oh no, it's transitory. We don't have to worry about it. BS. They always want to dismiss a problem the minute it shows up. and they want to minimize its significance. And maybe they hope that by doing that, they can wish the problem away by denying it exists. And so maybe they're doing the same thing again. But with respect to your second question about the Chinese banks, look, I don't own any Chinese banks. In fact, I don't really own banks anywhere in Asia. I don't own them in Hong Kong. I mean, I just have avoided the entire sector because I know that it's the sector that the governments have the most screwed up.
Right.
Because of what they've done with interest rates, right? Banks are a party to all this, right? And so banks are more vulnerable to problems based on the way their business models developed over the years in this artificial rate environment. So they're just disasters. Now, to the extent that the banks in China may have be smaller disasters than the banks in the United States or Europe. Yeah, I'm sure that's the case because rates in Europe and the U.S. were always lower than they were in China. So they weren't quite as low, but they were lower than they should have been.
Right.
And so mistakes were clearly made all around the world. Everywhere that rates were too low, mistakes were made because interest rates need to reflect the free market. They need to reflect the supply of legitimate savings and the demand for credit. And the market has to discover a price that balances everything and is at equilibrium. Just like we need the market to discover the price of everything else, whether it's the price of oil, the price of bread, the price of labor. Because whenever the government comes in and tries to fix a price that is different than the price that the market would discover, it's going to create a problem, right? So if they put a price cap on something, if they say we don't want oil prices to be above a certain level and they put a price cap, well, the result's going to be a shortage of oil, right? Too many people are going to want to buy it. Not enough people are going to want to produce it. You're going to get a shortage. And now what are you going to do? Ration, price control, all kinds of stuff happens when the government sets the price too low. The other hand, they could set it too high, like a minimum wage. The government says, oh, we don't like the wage in the market. We're going to set a higher minimum wage. Well, that means you have a surplus of workers, you have unemployment.
Right.
Employers don't want to pay the higher wage, but more people want to earn it. And so the market doesn't clear. Well, the same thing happens with interest rates. If the government says, we don't like the market rate of interest, we want to fix the interest rate at a lower rate than what the market would determine, well, what happens? Well, you get a shortage of savings, you get a surplus of debt, and you get problems in the economy. And particularly, you get problems in the banks. So I don't own the banks. I think there's trouble. But, maybe at some point I'll start looking at them if I think they get cheap enough, because I think all the bad news is out.
Right.
And then, maybe there's some good bargains in some of these banks. Now, I think the Chinese economy is in better shape to weather this storm than let's say the U.S. Or Europe for that matter. So I think the Chinese economy overall won't be as negatively impacted by the problems in their banks as, let's say, the U.S. would be with our banks, especially if in the process we lose the dollar as the reserve currency.
Right. Peter, they brought up a good point because I think, in the United States with our politicians, they necessarily can't make the best decision for the economy or for the country because I think they're always concerned with reelection. Isn't that right? I mean, they're always concerned about number one goal for every politician in America is how do I get reelected? So I think when you look at, for example, this crisis that the Fed has created, obviously there's some steps that need to be taken, but I think many U.S. politicians are very reluctant to take those steps. This is an interesting thought. Does that give China an advantage considering it is a one-party state and obviously there's no worrying about being reelected? They can just simply move quickly. I mean, if they need to address a situation, doesn't really matter what the public thinks, like we're going to make this decision and, this is what's best for the economy. What was your thoughts on that?
Yeah, it's kind of ironic and most people don't get this, but that is the downside of democracy. And, why a democracy is not a good form of government. I mean, it's not what we're supposed to have in the United States. It was not the intention of the founders, the founding fathers, to establish America as a democracy. In fact, it was specifically established to prevent democracy from rearing its head. We were created as a republic. And the founders were very familiar with the demise of democracies. They were very educated, unlike the people who are currently in Congress. They understood the dangers of government inherent in democracy. And so we created a republic. But over the years, all of the safeguards that have been built into the Constitution by the founders have basically, been eradicated, and the courts no longer really enforce the Constitution as it was meant to be applied to the government. And so we are more of the very democracy that the founders feared would ultimately be our demise. And those fears are coming true, because the problem with this democracy, as you said, is that decisions are made based on their political appeal, not based on their economic viability. So whatever gets done is going to be done based on how it impacts the elected representatives' prospects for the next election, which in America is every 2 years, right? The House of Representatives has to face the electorate every 2 years. And so they do not want to do something that will hurt in the short run, right? They're not willing to swallow bitter tasting medicine, even if it will cure the disease, because when the voters taste the medicine, they're going to vote for somebody else. Right?
Exactly.
You can't say, look, you got to suck it up because in 5 years, you're going to be better off. The voters are like, no, because the guy running against that guy is going to make all these commercials about, how bad this stuff is. Like, oh, you're cutting Social Security. Oh, you're throwing grandma, over a cliff. So they're not going to cut government spending. They're not going to do the right thing in a democracy. A democracy guarantees that they're going to do the wrong thing, because what's good politics is bad economics, and what's bad economics is good politics. So, this is where we're stuck. Whereas the Chinese don't have that problem. The Chinese leaders can actually think about the long term and what's best for Chinese, and they can tell them to swallow the bitter tasting medicine because they got no choice. They got to swallow it.
Yeah, absolutely.
And, it's like, weightlifting, no pain, no gain, right?
Yeah.
The U.S. politicians are not willing to ask the voters to have any pain, whereas the Chinese politicians can let the voters know there's going to be some pain, but you're going to get all this long-term gain, right? Not that I'm an advocate of the communism, far from it. I would prefer a republic, I would prefer a monarchy to a democracy, with a constitution that limited the power of the monarch. I think the UK was better off when they were more of a monarchy, not just in a figurative sense, but literally when there was a king there, they were a much more powerful nation, under the monarchy than they are under democracy, because there's no way any monarch would have ever taxed the British to the extent that they're taxing themselves. I mean, it never would have happened. I mean, no king could get away with what, democracies are doing, the governments are doing now under the guise of democracy. There would have been revolution. But so in that respect, though, given the Chinese position, yes, they are much better able to withstand this, much better to win a trade war or economic war, because they can take the pain. Not that their pain would be anywhere near as bad as the pain that we would have to actually endure in the United States. Plus, the Chinese, they're communist in that it's a communist party,
right?
But they do not embrace the communist ideology, at least not anymore, because there is a lot more free market capitalism taking place on the streets of Beijing than in any major U.S. city. If you are an entrepreneur, you're a young person and you're in China and you want to start a business, it's easier to do that in China than it is in the United States. You have fewer regulations to deal with, lower taxes. And so, there's more freedom there on that respect. Now, in totality, there's a lot of things that, where they're lacking. But the leaders know that Karl Marx was wrong, that it's not from each according to his ability to each according to his need, that you need the dynamics of free enterprise, of capitalism, that's where wealth comes from. And that's why the Chinese enjoy the living standard that they do. I mean, if they were still, operating under the principles, of Karl Marx, from Mao and all that, and, they would be nothing. There would be no industry in China. There would be no prosperity in China.
For sure.
They gave all that up because they realized it didn't work. Some countries haven't figured that outlet, like North Korea or Cuba, right? I mean, so they're not experiencing this economic boom. We don't have a huge trade deficit with Cuba, right? Because they actually are communist in Cuba, so they can't make anything.
Right.
We never had a trade deficit with the Soviet Union. Why? Because the Soviet Union was communist until it collapsed. And because it was communist, they didn't make anything.
Exactly. Yeah. Alex, you got one last question here, I think.
Actually, too, when people found out that Peter was coming on the show, they hammered my inbox and they just said, okay, fire away. Here's a friend of ours, a local friend of ours here, Daniel Dumbrow. And Peter, I know your take on this, but I want to hear you answer Daniel's question here. Daniel says the following.
That's a long
I'll read it out to you. And he follows you quite closely. He says, I know you've been a longtime critic of cryptocurrency. Indeed, the ecosystem is flooded with bad actors and the price is too volatile. But if we look at the increased distrust in the governments and the banks and consider the difficulty of taking physical custody of gold bars, could you ever see a place for a decentralized store of value that would easily allow for personal digital custody and that was somewhat isolated from any specific national currency, even if it ended up being something other than Bitcoin? What would it take for you to see the merit in the idea of a digital currency of the future? I know it's a long question.
The operative word there is store of value, right? Could there be a digital store of value that can replace a non-digital store of value, such as, let's say, gold, right? Well, I have to see what actual value is being stored, because when it comes to Bitcoin, I don't see any value there because I don't see that Bitcoin has any properties that that give it that value. So you can't store what you don't have. I understand all the decentralized part and all that, but I just don't see the value that's unique to Bitcoin when there are so many other decentralized cryptos out there that also have no actual utility or intrinsic value. Yes, people are losing trust in governments and their fiat currencies, but does that mean they're going to put their trust into a digital equivalent of a fiat currency? I mean, yes, the fiat currencies derive their value because the governments have decreed them to be valuable. But ultimately, it's not the government decree that makes fiat currencies valuable. It's the faith that the public has in that decree, right? Because once you lose confidence, it's got to look, the Zimbabwe dollar is still the currency of Zimbabwe. And all the government laws making it legal tender doesn't stop it from collapsing. And the same thing with the Reichsmark in the Weimar Republic. It doesn't matter, right? It's once the confidence goes, then the currency is gone, right? It's obliterated. And so Bitcoin, even though it's not, deriving value from a legal tender status, which actually makes it worse than a regular fiat currency, all of its value comes from trust. It comes from trust that other people are going to ascribe value to Bitcoin and are going to want to buy it, right? But what if that doesn't happen? What if people lose faith in Bitcoin? Either because something else better comes along, right? Just like, look at all the problems now. Oh, Google's getting in trouble because maybe people are going to search through Microsoft or, a Bing with their chat, with their AI or, and where did Microsoft come from? I mean, where did Google come from? But because before that, people were using Yahoo or other search engines that already went out of business because something better came along. So you have no idea why people may lose confidence in Bitcoin over the years, or maybe just the whole crypto fad is a fad and everybody loses interest. But here's my whole take on it is I do see value in a digital representation of money that can be more easily utilized in commerce, that could be a better unit of account, a better medium of exchange, right, than a physical bar of gold, right? Just like when we use gold as money originally, and gold has been money for a long time because of how well it works as money and how it's better than other commodities that could also be used as money and have been used in money historically as money. But one of the things that made gold a better money until it was corrupted by government was the ability to use gold as backing for currency, because that increased the utility of gold when you can store gold in a depository, whether it's a bank or a goldsmith, and issue notes that are redeemable in that gold and which derive their value from that gold, but can then be utilized in commerce instead of gold as a substitute for the gold. So instead of having to go and get my gold and giving it to you, or shave off a little bit of my gold from a bar, we could just have notes, paper, and we could exchange that instead of the gold, because we know the gold's there and we can get it whenever we want. So that was an improvement for gold. Blockchain, right, the internet, takes it to a much greater degree, because now that bar can sit in a vault somewhere, and instead of issuing paper currency that represents ownership of that gold, I can issue a digital currency, and we can, use a blockchain to authenticate and validate all of the transactions, right? So now I can do everything that Bitcoin promises but can't deliver on with a cryptocurrency fully backed by and redeemable in gold, because I can take a gram of gold, tokenize it, put it on a blockchain, and now everybody can transact commerce in it. In fact, we don't even need silver or copper or nickel anymore, because I can buy a pack of chewing gum and pay for it in gold, because I can pay for it with the digital currency, and each unit can be divided into a fraction of a gram, so that I can do all commerce. And the difference between that and Bitcoin is that it's actually stable enough to be used as a medium of exchange, and it actually has value to store. It has all the value of the gold that is backing up the crypto. Whereas, Bitcoin has nothing backing it up other than hype, other than faith. Right? It's, but it's a Ponzi, it's a pyramid. So it eventually has to collapse. So everything that people claim they want with Bitcoin, gold can do all that. The only thing that gold can't do is you have to have a third party involved that you trust to store that gold. But that has always been the case. Ever since the creation of currency, there has always been a third party that has been trusted. And because of competition, because nobody has a monopoly on being that third party, the third parties that want to be the custodians of the gold and issue the cryptocurrencies that are backed by that gold, they compete with one another based on that trust, based on that confidence. And so the free market will make sure that the most trustworthy entities are the most successful custodians, because it's those currencies that merchants are going to want to get paid in, that people are going to want to save. And once you build up a reputation for being a trustworthy custodian of gold, you don't want to lose that. That reputation has huge value in the market, because it will enable you to issue your tokens at some premium to the melt value of the gold, and that's value to the business. And just like anything else, people say, oh, we can't trust third parties. Well, if you couldn't trust third parties, there would be no insurance industry, right? All insurance is based on the commitment of the third party. You buy life insurance, and when you die, your beneficiaries get money. Where's the money coming from? The insurance company. You trust that the insurance company is going to make good on its obligation. It could go bankrupt, and your heirs will get nothing, right? But why do people buy insurance? Well, because these insurance companies build up reputations, and they have third parties that will validate. They get audited. So if you think that we can't have a monetary system based on gold and then digitized or tokenized, you just don't believe in capitalism. You just don't believe that the free market works, because it does work. It works in everything. Now, the only problem that I see to a world in which gold is remonetized and the private sector issues currency legitimate currency, not fiat currency, our governments are going to hate it. So governments will try to attack it with regulation. Well, they're already attacking Bitcoin with regulations right now anyway. They, but all governments won't be able to attack it, and they won't be able to eradicate it, right? Because they're not all, going to see it as a big threat. I mean, it will be a threat to the United States because it will be a threat to the dollar's role as a reserve currency, although the dollar may lose that role even without gold, just because it self-destructs on its own. But yes, I mean, there's going to be rules and regulations that will complicate it. Just like right now, they're trying to put more rules and regulations on Airbnb because it competes with hotels, on Uber or Lyft because they compete with taxi cabs. They put regulations on Federal Express because it competed with the post office. The government doesn't like competition, and so it tries to encumber its competition with expensive rules and regulations. So the same thing is probably going to happen with gold-backed cryptos, but that will simply give advantages to those gold-backed cryptos that are originated outside the United States or outside of any country that is imposing unnecessary regulations. It'll give a competitive advantage to the issuers that are not subjected to those regulations. But of course, everybody will be subjected to the free market regulations, which are the most effective means of regulating any enterprise.
So Peter, before I hand my last question over to Cyrus, I've been asked this many times throughout the week. A lot of people are getting really nervous with these markets. I mean, seeing banks disintegrate within 24 hours. Credit Suisse, never would have thought that it went to the wall so fast. I mean, shareholders have got to be extremely careful in the next few weeks, especially if they're owning the financials. How does a company like Credit Suisse go to pretty much zero overnight? But
yeah, well,
if you could, sorry, before you answer that, if you could also share your prediction on what do you think is going to happen here in the next maybe 1 year, 2 years in these markets, and how do we get out of this mess? Back over to you, Peter. Sorry.
Yeah. Well, first of all, I mean, what happened to Credit Suisse didn't just come out of the blue. I mean, look at a chart of its stock price, right? I mean, the price of that stock, I think before the 2008 financial crisis, the stock was maybe $60, $70 a share. And before it went bankrupt, it was $2, right? I mean, and so it had been steadily declining. And so then, with the bankruptcy, it went to 85 cents. Now, it should have gone to zero. I mean, I don't know how the politicians were able to circumvent, the rule of law in Switzerland to put the equity holders ahead of secured, creditors, bondholders. But it just didn't come out of left field. It reminds me of the quote, I forget who said it, how did you go bankrupt? Well, slowly at first, then all of a sudden, right? And so that's what's going on. And so a lot of other banks have been going bankrupt slowly over the years. And now they're going to, finish the process very quickly. But the governments are already trying to backstop that. I mean, that's what happened. I think had, let's say, the Fed and the U.S. Treasury not backstopped those deposits, those uninsured deposits at, Silicon Valley Bank or Signature Bank, that we may have had bigger failures immediately. But I think the moral hazard of those backstops is actually going to produce even more failures eventually. And I'm not talking about far in the future, maybe in the next several months, because what they have, inadvertently done, right? And again, it doesn't matter if this wasn't their intention. This is the consequence. It was the unintended consequence of their actions. But what they have done, they didn't want to say that all bank accounts are now insured to an unlimited amount, because they knew that would be bad, because, that's a moral hazard in and of itself. Plus, that would expose the U.S. government to even greater, unfunded liability, contingency liabilities for, trillions and trillions of dollars of deposits that are not currently insured that all of a sudden would have to be insured. But what happened is that by limiting the insurance to these few banks, by saying, look, there is no explicit guarantee that if you've got a $5-10 million account at a bank that is not systemically important, that we're going to cover you, right? That it's a case-by-case situation. We have to evaluate the bank and evaluate the impact on the overall economy of allowing, the uninsured depositors to lose money. And then we're going to decide if we want to extend this special privilege to your bank. And so the message that is sending to depositors around the country is, I don't want to take that chance. I don't want to leave it up to a coin toss. I got my money in a small bank. All these banks are loaded up with bad mortgages and long-term treasuries. There's a chance that my bank could fail. Why should I take that chance? What's the purpose? What's the upside for me? Nothing. I mean, what are they giving me, right? So people are going to take their money out of these smaller banks, local community banks, and they're going to deposit into these massive banks, or some of the banks perversely, like Signature Bank or Silicon Valley Bank, which are still in business. They're just being run by the government now. But they can put their money there because they know that the government has already said, look, you'll never lose any money in these banks. Right? We've already extended it. So they have basically created a run on smaller banks. And the worst part about it is some of these small banks, or a lot of these small banks, may in fact be solvent. But people are going to yank their money out of these solvent banks, rendering them insolvent, because none of these banks in a fractional reserve system can really handle a run, which is what the government has potentially created here by saying these banks are protected and these, who the hell knows, right? So why take a chance with your life saving, right? Now, the people who have 100,000 in the bank, 200,000, okay, they don't care, right? Because it's, the government's covering it, and that's also a moral hazard, and it's created a big problem. But the larger depositors, and those are probably the deposits where these banks make money. A lot of these banks probably lose money on these small accounts, right? They probably, they're subsidized by these bigger accounts, but the bigger accounts yank their money out of these small banks. Now you have another banking crisis, which is why I think that sometime soon, the government is going to make another mistake to try to offset the impact of its prior mistakes. And they are going to announce that for some temporary period of time, I mean, they're not going to say it's permanent, but for the foreseeable future, whatever, they're going to have to say that all deposits are insured up to 100%. But that's because that's the only way they can stop the run on the small banks.
Right.
And kind of level the playing field between the too big to fail systemically important banks and everybody else. Because the only way these small banks would be able to stay in business if you take on much greater risk when you put your money there, would be to pay much higher rates. They would have to say, look, I know, if we fail, you could lose all your money. And so we're going to pay you double or triple what these big banks are paying. And we're going to pay you for taking on this risk. Well, they can't afford to do that. They would render them uncompetitive. They would go out of business. So the government has set the stage for another mistake to avoid this bigger crisis. But, the fact that they're going to have to do this shows you how sick the banking industry is. The government assured us after 2008 that their response, all the new regulations, would make sure that what happened in 2008 would never happen again. Well, I said that wasn't true, that the government, through its new regulations, not only guaranteed that it would happen again, but that it would be worse. And it is happening again. And it is going to be worse. The government caused the 2008 financial crisis, and they've caused the 2023 financial crisis for the same reason. It's the same foolish policies that created both. And in fact, really, what this is in 2023 is just a continuation of 2008. We just had a long intermission, right, between the opening act and, the curtain call. But we're just concluding the crisis that was interrupted by bad monetary and fiscal policy.
I completely agree. I'm going to pass this over to Cyrus. Cyrus, before I pass it over, the best comment I heard this evening: has Peter Schiff ever been right?
Well,
that one I'm going to frame that. I love
the people who say that don't have any idea what I've been saying. I mean, they know that I've been calling for like a dollar collapse, runaway inflation, and all they say is, well, we haven't had that, right? We haven't had the dollar crash. We haven't had runaway inflation. He's been calling for $5,000 gold, and look, gold is 2,000. So, he's wrong. And yeah, some of the things that I have forecast would be the consequence of a lot of other forecasts that I've made haven't happened. But if you look at the entire scheme of my forecasts and the things that I have been writing about and speaking about and warning about for more than a decade, and look at how much has come true, how many things that I said would happen have in fact happened for the precise reasons that I said they would happen and have played out the way I forecast they would. And then if you look at all of the people in the mainstream who supposedly have credibility, who got none of this right, in fact, who specifically said that none of this stuff that happened and that is happening could even possibly happen. I mean, those are the broken clocks, the ones that have been constantly saying everything is great. Now, just because the worst part of what I've been forecasting, the ultimate consequence hasn't happened. You can't discredit everything else that I've said. And if you want to wait for the dollar to be completely worthless and gold to be tens of thousands of dollars an ounce and everything to implode, to say, okay, yeah, I guess you were right. Well, what good is that? Because you're broke. You have to recognize that, gee, 90 whatever percent of what this guy has said has happened, right? Maybe he knows what he's talking about. And if he got the other 90% right, maybe the other 10% is going to happen too. The guys that were wrong 90% of the time, why should the last 10%, why should they be right about that? So I think it's smart people who can really do their own research and see what I've been talking about and, read it. They're going to recognize that, this Schiff guy, he's right.
I agree, Peter.
It's not because I'm so smart. I'm not saying that I'm some kind of genius. It's just that everybody else is so dumb, or they have a vested interest in lying, one or the other. But
I agree.
I'm telling the truth.
I know. And that's why at the start of the show, we played that 2-minute clip about your predictions, 2006, 2007, 2008. And that is exactly why we brought you on this panel tonight, was to try to at least give these people, send them some alarm bells on what's going on. And when somebody said to me, man, this economy is going to get wrecked, it's going to be terrible. I said, go back, look at 2006, 2007, 2008, Google Peter Schiff was right. And they said, get him on the show. I said,
and
we'll try.
I was warning about stuff in 2002, 2003. I just wasn't on TV back then. But I pointed out, as soon as the Fed went to 1%, I was like, look, this is bad. This is what it's going to do. And then as the bubble got bigger and bigger, my alarms were louder. But then I eventually got invited on to like CNBC. I didn't start until 2005, but the producers had been reading my stuff on the internet for a while before they invited me on to discuss my perspective. And this is when they were a lot more honest about having the other side on. I mean, because once all my predictions came true, they kind of banished me from their air. They didn't want me coming on anymore. And they just kind of said, well, he's just gloom and doom. Well, okay, well, why did you have me on in 05, 06, 07 then? I mean, it was, but because back then it was easy for them to make fun of me. It wasn't so easy after everything they made fun of actually happened, yeah, so the point is you can see these things coming long in advance, but it didn't take me until 2006 to know the error that the Fed was creating. And that's why when they went to QE and 0% rates in 2009, I immediately began warning about the negative consequences back then, right? When they said, oh, QE, it's just a one-time thing. I said, no. I said, there's going to be more QEs than Rocky movies. And now we're on QE 5, right? I mean,
for sure.
I said it was a monetary roach motel. They could check in, but they couldn't check out. I said the balance sheet would never shrink. When Bernanke, when he first went to Congress explaining why he wasn't monetizing the debt, he said, well, we're not going to keep these bonds on our balance sheet. We're going to sell them. It's temporary. I said he was lying. Here we are, 12 years later. The balance sheet, they're still there. They've been rolling these bonds over for a dozen years. I mean, the balance sheet is 8.7 trillion. So, I saw this coming from a mile away. The problem is I saw it so early that a lot of people think I'm wrong because I've been warning for so long. But I've been warning about an event that I couldn't possibly know the exact time that it would happen. But obviously, when they go back in 100 years and they write the history books, it's not going to matter, that I was 10 years early or whatever. I mean, it's all in the same time period. Like, here's the people that were warning about the stuff that happened, right? And it's this generation of Americans, or a couple of generations that are going to have to deal with the consequences. And anybody who heeded my warning and took action personally, at least will diminish their own financial suffering as a consequence, because they won't own dollars or treasuries. They'll have positions in gold and silver. They'll own companies in emerging markets, good dividend-paying value stocks that will benefit as these events transpire. So that's what people can do. And you still have time. If you're not currently a client of mine, anybody anywhere in the world can open up an account with my asset management company. You can't buy my mutual funds, but you can have an account with Europe Pacific Asset Management. We manage money for people all around the world. And my principles and my philosophy are going to be what is driving the investment strategy. And if I'm right about everything, and I think I am right about this big picture stuff, then the portfolios that we manage will thrive as the rest of my forecasts come true.
Yeah. Yeah, Peter, thank you so much for coming on the show today. It's been a pleasure to spend some time with you. And I think it's important too, because one of the, as we're both Americans, I mean, we do have this unique thing here in this country where we have this American exceptionalism. And I think that's why a lot of people, they don't want to say the truth, or maybe they're just ignorant or blind to it, because it's like, well, we're America. We've got the best free market. We've got the best capitalism. We're the best banks. We're the best. We're the best. We're the best. So it's kind of, we're always just feeding our egos and just saying we're always the best, where it's like, hey, let's take a step back and start looking at what's going on around in the world and what's going on. I mean, I think it's been a pleasure to listen to you. It's been very nice. I think you brought some really great insights here, and I know our guests and our viewers have really enjoyed today's show. So that's all I have for today. I'm good. Thank you so much, Peter. I really appreciate it. I think that was a great ending. Just really appreciate it. We hope to welcome you back to the show maybe in the future as these things continue to develop. I mean, this is obviously going to be a continuing story that we're going to see for many months and years to come. So thank you very much for your time.
Thank you.
All right. Thanks, Peter. We're going to go to an outro, everybody. And thanks again, Peter. And if you're watching on Peter Schiff's channel, don't forget to check us out, Cyrus Jansen and Alex at Reportify Media. You guys take care. Have yourself a great evening, and we'll talk to you guys soon.